Everyone thinks the Rothschilds never lost, that they were always 10 moves ahead, the ultimate chess masters of global finance. But in the 1870s, something cracked, and not quietly. The official story? A simple market downturn, the usual boom and bust of speculative railroads. But if you stop there, you miss the deeper truth and the deeper warning. Because what collapsed wasn't just a set of rail stocks. What collapsed was a system of belief. Belief in endless expansion, belief in elite invincibility, belief that empires could print promises faster than reality could deliver steel and coal. Here's the paradox. The Rothschilds, the same dynasty that financed kings, brokered peace treaties, and once stabilized the entire Bank of England, got caught in their own illusion. They believed in perpetual motion. But finance doesn't run on belief. It runs on cash flows, metals, and margins. By the early 1870s, Europe's railways looked like today's tech sector, unstoppable, essential, and inflated. Every mile of track was seen as wealth creation. Every new bond issue was progress. Bankers, especially in France, Austria, and Germany, poured money into it. But the Rothschilds did more than fund it. They structured it. They turned sovereign debt into iron and wood, laying thousands of kilometers of track across the continent. And then it stopped. Not with war, not with revolution, but with math. Interest payments couldn't be met. Passengers didn't come. Freight didn't pay. And the Rothschild-led banking networks began to shake. You'll hear about the crash of 1873, the Long Depression. What they won't tell you is this. It started with one of the most powerful financial dynasties in history, betting that the future would always resemble the past. It didn't. And in that gap, between optimism and obligation, the modern rules of collapse were quietly written. A bubble is never just about greed. It's about timing, overreach, and the fatal lag between capital and reality. To understand how the Rothschilds, the most powerful banking family in 19th century Europe, ended up underwriting their own crisis, you have to rewind. Not just to the 1860s, but to the very logic of railroads, bonds, and empire. This wasn't just about trains. It was about time, territory, and trust. After the 1815 Congress of Vienna, the Rothschilds weren't just bankers. They were infrastructure. They didn't move money. They moved nations. When 5 branches of the family were positioned in Frankfurt, Paris, London, Naples, and Vienna, they formed something like a proto-central bank, but private and faster than any government. By the 1830s, they had already financed the Belgian state, the reconstruction of France, and the expansion of British imperial credit. But in the 1840s, they found a new machine to monetize, the railroads. Railroads were a dream weapon for banks. Why? Because they combined 3 magical ingredients: government backing, corporate structure, and public excitement. The tracks didn't just promise faster trade, they promised national unity. A map of rail lines was a map of empire. And for investors, they offered something rare: visible progress. The Rothschilds were among the first to realize this could be financialized. Take the Austrian Empire. It was large, fragmented, and desperate for integration. The Rothschilds proposed the Nordbahn, a northern railway network, and offered to finance it through bonds. But not ordinary bonds. These were state-guaranteed infrastructure instruments. The profits would come later. The payments? Now. That's how the game worked. Convert future movement into present money. Investors in London, Paris, and Frankfurt bought into Austrian, Italian, and French railway schemes, believing that passengers, freight, and taxes would one day repay the debt. But in the meantime, governments handed out privileges, and bankers skimmed fees off the bond issues. By 1860, the Rothschilds had controlling interests in dozens of rail systems across Europe: the Chemin de Fer du Nord in France, the Kaiser Ferdinand's Nordbahn in Austria, the Lombard-Venetian lines in Italy. They didn't just fund the rails. They owned the rails, the mines, the rolling stock, even the companies that supplied coal and iron. This was vertical integration, 19th century style, a closed system of money and metal. But more importantly, they also wrote the rules. Governments let the Rothschilds structure the deals. That meant underwriting bond sales, setting interest rates, choosing routes, and deciding which lines would get state guarantees. The lines weren't always chosen for economic logic. Often they were laid for political influence, a station here, a branch line there, to curry favor with monarchs or regional elites. This was the blueprint: monetize the future, leverage state power, export bonds, and collect rent. The bankers got fees, the politicians got growth, the public got jobs. Everyone had a reason to keep expanding. But there was a catch. Railroads are capital intensive. They take years to build and decades to pay back. Every kilometer of track was laid on borrowed money. If the flows ever slowed, from freight, from subsidies, from new investor inflows, the system wouldn't just stall, it would reverse. By the late 1860s, that risk was quietly growing. Wars, like the Austro-Prussian conflict in 1866 and the Franco-Prussian War in 1870, disrupted logistics and drained treasuries. The unification of Germany shifted power and trade routes. And speculative bubbles, especially in Vienna and Berlin, began to inflate rail stocks beyond fundamentals. Still, the Rothschilds stayed in. Why? Because they had to. Their empire was no longer just about finance. It was locked into fixed assets: tracks, stations, locomotives, coal mines. If the rail system collapsed, their reputation as the ultimate safe pair of hands, the bankers' bankers, would unravel. And reputation was everything. So they doubled down, structured new bond issues, took equity stakes, secured fresh guarantees. It worked for a while, but you can only write tomorrow's tickets on yesterday's rails for so long. The system was a masterpiece of 19th century financial engineering, but like all masterpieces, it had a flaw hidden in plain sight. It required eternal growth. And when growth slowed, the weight of the machine turned inward. Because systems don't collapse from bad intentions, they collapse when the math no longer works. If you're still watching, ask yourself, what's the equivalent today? What infrastructure are we all betting on without asking if it can ever repay the debt? Drop a comment if this part reshaped your view of 19th century finance. By the early 1870s, it felt like nothing could go wrong. Rails were being laid faster than ever. Steel production was booming. Investors in London, Paris, and Berlin were throwing money at anything with the word railway in it. And why not? Every kilometer of track promised a return, in trade, in taxes, in the illusion of infinite motion. It was the age of speed. The future had steel wheels, and the Rothschilds were at the center of it all, orchestrating the growth like conductors of an imperial symphony. From the Viennese palaces to the boardrooms of Paris, they sold not just bonds, but belief. The belief that geography could be conquered with enough credit. Look at the numbers. Between 1865 and 1872, France laid down more than 10,000 kilometers of new track. Austria-Hungary doubled its rail coverage. In Prussia, newly unified under Bismarck, the government leaned heavily on private investment, most of it foreign, to knit together the new German Empire with trains. To the average person, this wasn't a bubble. It was civilization. Towns begged for lines to pass through them. Landowners donated property in exchange for station stops. Newspapers celebrated each new rail opening as if it were a national holiday. And behind the scenes, banks quietly packaged it all into debt instruments, sold to the wealthy, to the bourgeoisie, to retirement funds, even to municipalities. Each line was funded by bonds. Bonds were backed by the expected income from passenger tickets, freight contracts, and, when those fell short, government subsidies. But here's the trick. The numbers were always optimistic, based on best-case scenarios. The Rothschild model depended on momentum, on new lines funding old ones. And as long as that cycle continued, nobody questioned the arithmetic. They called it progress. But it worked more like a Ponzi scheme with iron tracks. Still, the illusion was powerful. The Vienna Stock Exchange was euphoric. From 1868 to 1872, stock values for major rail companies tripled, sometimes quadrupled. Speculative firms popped up overnight with names like Imperial Danube Rail Holdings or Austro-Hungarian transcontinental. Many had no locomotives. Some had no track, but they had paper, shares, bonds, guarantees. And paper moved faster than trains. Every player had a role. Banks underwrote new issues. Governments signed charters. Investors bought shares. Engineers built lines. Everyone was paid as long as the system expanded. And the Rothschilds? They weren't just participants. They were validators. If the Rothschild Bank touched a project, even a minor one, it signaled confidence. Investors followed. Prices rose. And the machine rolled on. In France, the Chemin de Fer du Nord, backed heavily by Rothschild capital, became a darling of the market. In Austria, the Südbahn and Nordbahn networks looked like the nervous system of the empire. Every successful expansion justified the next. But beneath the surface, costs were rising. Labor wasn't cheap anymore. Steel prices fluctuated. Maintenance costs for aging tracks crept up. Worse, traffic projections were missing their marks. Many rural lines were barely used. Some were symbolic, political gestures to satisfy regional elites. But the bonds behind them still paid interest, regardless of performance. That was the silent weight pressing on the system: interest payments. In the background, the gold standard ruled everything. Currencies were tied to gold. Governments couldn't inflate their way out. So when a line failed to generate profit, someone had to absorb the loss. And that someone, often, was the bank that issued the bond. The Rothschilds were sitting on a mountain of rail-linked liabilities. But the market didn't see risk. It saw reputation. If the Rothschilds are in, investors thought, we're safe. That's how illusions work. Not with lies, but with trust that no one dares to question. The system looked perfect until it had to stop growing. And like all bubbles, this one didn't burst with a bang. It deflated with silence. Fewer passengers, missed payments, warnings whispered between banks, quiet runs on deposits. But in 1872, that wasn't visible yet. All the lights were still on. The trains were still running. And the future, on paper, was still golden. Because in a world of promises, as long as the next loan gets funded, no one asks how the last one will be repaid. It started with a whisper. In May 1873, a bank in Vienna, one of many quietly overexposed to rail stocks, failed to clear its payments. Nothing dramatic, just a delay. But in finance, delays are signals, and this one triggered an avalanche. What followed was not just a crash, it was a revelation. The Vienna Stock Exchange collapsed on May 9, 1873. Panic spread across Europe like fire through dry brush. Berlin, Paris, London. The dominoes didn't fall because of war or revolution. They fell because the math no longer worked. For years, investors had trusted the system. They had bought the bonds, held the shares, and watched the Rothschild name as a compass. But suddenly the compass spun. Companies stopped paying dividends. Bonds defaulted. Construction halted. Projects were frozen mid-track. And with that, confidence died. Banks rushed to liquidate assets. But what do you sell when everyone owns the same thing? Rail shares plummeted. In Prussia alone, stock values dropped over 50% within weeks. Margin calls piled up. Investors, from wealthy barons to middle-class savers, were wiped out. And at the center of it all stood the Rothschilds. Not ruined, but exposed. Their empire wasn't bankrupt, but their prestige had been built on an illusion of invincibility. And now they were vulnerable. The Chemin de Fer du Nord saw its revenues collapse. In Austria, their rail holdings began bleeding cash. New bonds couldn't be sold. Old ones couldn't be serviced. Suddenly, the very tools the Rothschilds had mastered, long-dated, state-backed, yield-generating rail bonds, became toxic. They weren't the only ones, but when the most trusted name falters, the whole system reevaluates risk. The Panic of 1873 marked the beginning of what would later be called the Long Depression, a global economic stagnation that lasted over 2 decades in some countries. But in reality, it wasn't a depression. It was a deleveraging, the painful unwinding of financial illusions. It was also the death of an era, the idea that expansion could be infinite. The rail networks didn't disappear, but the belief that they could grow forever, funded endlessly by debt, vanished. Investors began asking harder questions. How many passengers are really using these lines? How many tons of coal are moving? Are we financing commerce or just shuffling paper? The Rothschilds survived by shrinking. They pulled back from speculative ventures, focused more on hard assets and central banking connections. They stopped selling the future and started defending the present. But the damage was done. The collapse revealed something timeless. When your system depends on momentum, a pause is a crisis. When your empire depends on credit, a question is a threat. And when the world believes that a single name, a single family, or a single network is too smart to fail, failure becomes contagious. The railway mania of the 1860s was not just about infrastructure. It was about the psychology of wealth, a belief that capital could bend time, geography, and even political will. But in the end, it hit the same wall every bubble does. Real returns could not keep up with promised payouts. It wasn't corruption that killed the system. It was compounding. Arithmetic cannot be deceived, not by status, not by optimism, not by centuries of reputation. And if you're watching this in a world still built on debt-fueled infrastructure dreams, ask yourself, where are today's railroads? If you've ever heard the phrase, too big to fail, you're already living in the echo of 1873. Because what collapsed back then wasn't just railroads or markets, it was the illusion that a system engineered by elites could never unravel under its own weight. And that idea, the belief that we can borrow the future to fund the present, didn't die in the 19th century. It became the blueprint. Let's be clear. The rail bust of the 1870s was the first modern credit collapse. It taught financiers one hard truth. If you want to build something massive, be it railroads, cities, tech, or even empires, the fastest way is with debt wrapped in belief. Debt gives you scale. Belief keeps the cost low, until the math breaks. Sound familiar? Jump to the 1990s dot-com boom. Billions were poured into internet startups that had no profits, just promise. Venture capital replaced bond syndicates. Clicks replaced freight. Yet the mechanism was the same. Build fast, monetize later, and trust that markets will forgive the present if the future looks big enough. Then 2008, the housing bubble. Mortgages, bundled, sold, sliced, and guaranteed. Just like 1870s rail bonds, everyone owned a piece of the same optimism. Then prices stalled, and once again liquidity turned to vapor. Or look at China today. Since 2008, it has built more high-speed rail than the rest of the world combined. It's a miracle of engineering, but also a warning. Trillions of yuan in municipal debt tied to passenger projections that don't always materialize. New cities, empty stations, quiet tracks. The same belief, build now, repay later. And who underwrites it? Shadow banks, state banks, and increasingly global investors buying into Chinese local government debt. It's the Rothschild model, scaled for the 21st century. Even the European Central Bank today buys government debt with digital money, promising that low interest forever will keep the system running. But like the Rothschilds discovered, forever has an expiration date. The point isn't that railroads were bad, or that growth is dangerous. The point is this: every system that promises perpetual motion eventually faces friction. In 1873, the friction was iron and steam. Today, it's bandwidth and bandwidth fees. It's credit downgrades, energy shortages, climate shocks. The rails have changed, the logic hasn't. And the Rothschild collapse shows us what happens when reputations become substitutes for scrutiny. When big names silence big questions. When entire markets stop asking, who's really going to pay for this? It's not just history. It's infrastructure, politics, and psychology. Because what followed 1873 was not just a depression. It was a shift in power. Smaller banks disappeared, credit tightened, the state stepped in, new banking laws emerged, and slowly the control over capital moved from family dynasties to central banks and institutional bureaucracies. That wasn't a coincidence. It was a design correction. Today, central banks play the role the Rothschilds once did, issuing guarantees, backstopping losses, projecting calm. But central banks don't print belief, and when trust runs out, no name, no institution, no policy can stop the reckoning. So the question isn't if it will repeat, it's where. In real estate, sovereign bonds, student debt, tech platforms with no profit but infinite valuation. The structure is the same: scale fast, hide risk, and pray that growth covers the gap. But systems don't collapse because of bad actors. They collapse when promises grow faster than the underlying ability to deliver. If this part helped connect 1873 to your world in 2025, tell us, where do you see today's railroads being laid, and where do you hear the tracks starting to creak? This wasn't just a financial event. It was a moment when belief collided with limits, when even the most powerful bankers on earth were reminded that credit is not infinite and growth is not guaranteed. The Rothschilds weren't evil. They didn't set out to deceive the world. In fact, they did what every system still does today. They projected the future into the present, turned time into money, and trusted that everything would scale. And for a while, it did. But here's the lesson the 1870s refused to hide. You can borrow belief, but only until the interest comes due. Every empire, whether built on railways, real estate, or artificial intelligence, carries within it a hidden timer, a countdown that begins the moment ambition outpaces income and prestige replaces accountability. In 1873, the Rothschilds bet on perpetual motion. Today, we bet on perpetual liquidity. Same gamble, different engine. And still, the numbers always win. Not because they're cruel, but because they're honest. When interest outgrows trade, when credit expands faster than trust, when systems rely more on reputation than on receipts, history doesn't need a revolution. It just needs a pause, and everything unravels. So if you're hearing this in a time of trillion-dollar deficits, infinite central bank support, and tech companies valued higher than nations, remember the moral of 1873. Where power ends, arithmetic begins. And arithmetic doesn't care who you are. If this gave you a truth that history textbooks forgot, share it and tag someone who still thinks systems collapse out of nowhere. Because once you see the structure, it never looks the same again.